Before we dive in, please remember that this video is for informational and educational purposes only. I am not a financial advisor, and this presentation is not a substitute for professional financial advice. The world of lending is complex and your personal situation is unique. Always consult with a qualified financial professional before making any major financial decisions. Your home is your most valuable asset, so let's treat it with the respect and diligence it deserves. Imagine this for a second. You walk into your kitchen, and the first thing you see are those honey oak cabinets from 1992. The laminate countertop has a burn mark from that one time you forgot a hot pan, and the linoleum floor is peeling up in the corner. You have a vision. You see a beautiful island, quartz countertops, new stainless steel appliances. You've been pinning ideas on Pinterest for months. You know this renovation will not only make your life better, it'll add serious value to your home. You've done the math. You have a ton of equity built up in your house. It's like a secret savings account you've been contributing to with every mortgage payment. Now's the time to use it. So you start Googling, and that's when the dream starts to feel like a nightmare. You're hit with a tidal wave of acronyms and jargon. HELOC, home equity loan, cash out refi, fixed rates, variable rates, draw periods, balloon payments. Suddenly, your simple kitchen renovation project has turned into a final exam for a finance class you never signed up for. It's overwhelming, it's confusing, and it's designed to be that way. Because when you're confused, you make mistakes. And in the world of home finance, mistakes aren't measured in dollars. They're measured in tens of thousands of dollars over the life of a loan. What if I told you that by the end of this video, all of that confusion will evaporate? What if I told you that you will understand these tools so clearly, you'll be able to explain them to your friends at a backyard barbecue? My promise to you today is simple. We are going to demystify the two most powerful and most misunderstood tools for tapping into your home's equity: the home equity loan and the HELOC. We're not just going to define them, we are going to put them in the ring head-to-head and show you exactly which one is the financial sniper rifle for your specific goal, and which one is a financial hand grenade that could blow up in your face if you're not careful. You will leave here knowing with 100% certainty which path is the right one for you, for your family, and for your financial future. Because making the right choice here isn't just about getting a new kitchen. It's about being smart with the single biggest asset you will likely ever own. It's about turning a passive number on a statement into an active tool for building wealth, crushing debt, and achieving your biggest goals. So let's get into it. At the highest level, you need to understand one core concept. Both a home equity loan and a HELOC are types of second mortgages. That sounds a little scary, but all it means is you're taking out a new loan that uses the equity in your home as collateral. Your equity is the difference between what your home is worth and what you still owe on your primary mortgage. If your house is worth $500,000 and you owe $200,000 on your mortgage, you have $300,000 in equity. That equity is powerful. It's wealth that you own. Lenders see that equity as security. They're willing to lend you money against it because if you fail to pay, they know there's a valuable asset they can go after. That's why the interest rates on these loans are almost always significantly lower than unsecured debt like credit cards or personal loans. You're putting your house on the line, and in return you get access to money at a much cheaper rate. Now this is where the road forks. This is the critical distinction you have to burn into your brain. The home equity loan and the HELOC deliver that money to you in two completely different ways, and that difference changes everything. Let's start with the old school, the classic, the heavyweight champion of predictability: the home equity loan. Think of a home equity loan as a one-time transaction. It's like going to your home's personal ATM, but you can only make one big withdrawal. You apply for a specific amount, let's say $75,000 for that dream kitchen. If you're approved, the bank cuts you a check or wires you the full $75,000 right then and there. Boom! The money is in your account. From that moment on, it's a very straightforward installment loan. It's almost identical to a car loan or your original mortgage. You get a fixed interest rate. That rate will never ever change for the entire life of the loan, which is typically anywhere from 5 to 30 years. Because the rate is fixed and the loan amount is fixed, your monthly payment is also fixed. It will be the exact same amount on day 1 as it is in year 15. It is the definition of predictability. You know exactly what you owe, exactly when you owe it, and that number will never surprise you. Who is this for? The home equity loan is for the planner. It's for the person with a specific large one-time expense. You've gotten 3 quotes for your kitchen renovation and the final number is $72,800. You need that money, you need it now, and you know exactly what it's for. Or maybe you have $40,000 in high-interest credit card debt that's eating you alive. You can take out a home equity loan, pay off all those cards in one fell swoop, and consolidate it all into one manageable lower-interest monthly payment. The beauty of the home equity loan is its simplicity and its stability. It's a fortress. In a world of economic uncertainty, with interest rates going up and down, your payment is an anchor. It doesn't move. You can budget around it with absolute precision. There are no surprises. But that strength is also its biggest weakness. It's rigid. Once you get that lump sum, that's it. The door is closed. If your renovation goes over budget, which let's be honest, they almost always do, you can't just go back and ask for a little more. You'd have to apply for a whole new loan. And you're paying interest on the entire $75,000 from the very first day, even if you don't spend it all for 6 months. You took the full dose, so you pay for the full dose. Now let's turn to its more flexible, more dynamic, and potentially more dangerous sibling, the HELOC, or home equity line of credit. If the home equity loan is a one-time lump sum, the HELOC is the exact opposite. Think of a HELOC as a superpowered credit card that's secured by your house. When you get approved for a HELOC, you don't get a big check. Instead, the bank gives you access to a line of credit, a maximum amount you can borrow. Let's say you're approved for a $100,000 HELOC. That money just sits there, available to you. You don't pay a dime in interest on it until you actually use it. This is typically structured in 2 phases. The first is the draw period, which is usually the first 10 years. During this period, you can draw money from the line of credit as you need it, up to your limit. You can write a check against it, use a special debit card, or transfer funds online. Need $20,000 for the contractor's first payment? Done. A month later, need $10,000 for the appliances? No problem. You borrow what you need when you need it. And here's the key. You only pay interest on the amount you've actually borrowed, not the total credit line. If you have a $100,000 line but have only used $30,000, you only pay interest on that $30,000. During this draw period, you can also pay back the principal, and whatever you pay back becomes available to borrow again. It's a revolving door of credit, just like a credit card. This flexibility is incredibly powerful. The HELOC is perfect for someone who has ongoing projects or unpredictable expenses. Maybe you're doing that kitchen renovation in phases, or perhaps you want a financial safety net, an emergency fund on steroids for unexpected medical bills or a job loss. It's also a phenomenal tool for a real estate investor who needs quick access to capital to jump on a new property deal. The money is there on standby, ready to be deployed at a moment's notice. But this incredible flexibility comes with a huge catch, and this is where people get into trouble. The interest rate on a HELOC is almost always a variable rate. This means it's tied to a benchmark financial index, usually the prime rate. When the Federal Reserve raises interest rates, the prime rate goes up, and the interest rate on your HELOC goes up with it. Your monthly payment, which might have been comfortably low one year, could suddenly skyrocket the next. That lack of predictability can be terrifying, and can absolutely wreck a household budget if you're not prepared for it. Then, after the draw period ends, typically after 10 years, the HELOC enters the repayment period. The revolving door closes. You can no longer borrow money from the line of credit. You now have to pay back the remaining principal and interest over the next 10 to 20 years. Your payment will likely increase significantly at this point because you're now paying back both principal and interest, not just the interest-only payments that are common during the draw period. This is what's known as payment shock, and it catches millions of people by surprise. So right away you can see the fundamental conflict. On one side you have the home equity loan, stable, predictable, and simple. A rock. On the other side you have the HELOC, flexible, powerful, and adaptable. A river. A rock is safe, but you can't change its course. A river is powerful, but it can flood. One gives you peace of mind. The other gives you options. One is about locking in a known cost for a known project. The other is about creating a financial tool for an unknown future. The question isn't which one is better. That's the wrong question. The only question that matters is, which one is better for you? For your project? For your risk tolerance? For your financial discipline? Choosing the wrong one is like trying to use a screwdriver to hammer a nail. You might eventually get it done, but it's going to be messy, inefficient, and you're probably going to hurt yourself in the process. So let's grab that financial toolbox and start by examining the first tool, the big one, the heavy hitter, the traditional home loan. This is your hammer. It's designed for one primary job, and it does that job with incredible force and stability. A home loan, or what most of us call a mortgage, is what's known as an installment loan. Think of it like a car loan but for a much bigger and more important asset. The bank gives you a giant single pile of cash, a lump sum, to buy a house or to refinance the one you already own. In return, you agree to pay it back in regular, predictable installments, usually every month over a very long period, typically 15 or 30 years. The defining feature, the very soul of a home loan, is that lump sum. You get all the money on day one. It hits your account in one glorious, terrifying transaction. From that moment on, the deal is set. The loan amount is fixed, and your only job is to pay it back piece by piece, month by month, year by year. You can't go back to the bank in 5 years and say, "Hey, can I have a little more from that original loan?" It's a one-way street. The money flows from them to you and then back from you to them. That's it. Now, within this world of home loans, you face your first major crossroad. The choice between a fixed-rate mortgage and an adjustable-rate mortgage, or ARM. This decision alone can shape your financial life for decades. A fixed-rate mortgage is the bedrock of American homeownership. It's the comfort food of finance. The interest rate you lock in on the day you sign the papers is the interest rate you will have for the entire life of the loan. 30 years? That rate is your rock. It doesn't matter if the economy goes crazy, if inflation skyrockets, or if the Federal Reserve starts hiking rates like they're climbing a mountain. Your principal and interest payment will not change. Not one penny. It is the absolute pinnacle of predictability. You can budget for it with your eyes closed. People who locked in rates of 2.5% or 3% a few years ago now look like financial wizards, because while the world outside is a storm of economic uncertainty, their biggest monthly payment is a calm, unchanging anchor. Then you have the wild card, the adjustable rate mortgage. An ARM is a bit of a gamble. It lures you in with a beautiful, often significantly lower, initial interest rate for a set period, say 5 or 7 years. This is called the teaser period. During this time, you're enjoying a lower payment than you'd get with a fixed-rate loan, feeling smart, saving money. But, and this is a but, the size of a house. Once that initial period is over, the rate adjusts. It starts to float, tied to a specific financial index. If market rates have gone up, your rate goes up. Your monthly payment goes up. And it can continue to adjust periodically, usually once a year, for the rest of the loan's term. Who on earth would take this deal? Well, someone who doesn't plan on being in the house for the long haul. If you know you're going to move and sell the house in 4 years, a 5-year ARM could save you thousands in interest payments. It's also for people who confidently expect their income to increase substantially, so they can easily absorb a higher payment down the road. But it's a calculated risk. The 2008 financial crisis was fueled, in part, by people taking on ARMs they couldn't afford once the rates adjusted. They bet on a future that never came, and the hammer came down hard. So when is this hammer, this big, powerful lump sum loan, the right tool for the job? The most obvious answer is when you're buying a house. That's its primary function. But its second job is where it goes head-to-head with a HELOC, the cash-out refinance. A cash-out refi is exactly what it sounds like. You trade in your old mortgage for a new, larger one. You use part of the new loan to pay off the old one, and you get to keep the leftover cash. For example, if you owe $200,000 on a home that's now worth $400,000, you might be able to get a new mortgage for $300,000. You'd use $200,000 of that to wipe out your old loan, and you'd walk away with a check for $100,000. Your mortgage payment is now based on the new $300,000 loan, but you have a huge pile of cash to work with. This is the perfect solution for a very specific type of need. The large, single, planned expense. Let's imagine a couple, we'll call them Mark and Jessica. They've been in their home for 10 years. They love their neighborhood, but the kitchen is straight out of the 1980s and they dream of adding a master bathroom. They get a contractor, draw up plans, and get a firm quote. It's going to cost $120,000. Not a penny less. This isn't a series of small projects. It's one massive undertaking. They know the exact amount they need, and they know they need it all at once to pay the contractor in stages. For Mark and Jessica, a cash-out refinance is the perfect hammer. They need to smash this one specific financial goal. They apply, get approved for a new mortgage that rolls their old one and the $120,000 into a single loan. Maybe they lock in a 30-year fixed rate. Yes, their monthly payment is higher now, but it is a known quantity. For the next 30 years, they know exactly what that payment will be. They can budget around it. They sleep soundly knowing that a sudden spike in interest rates won't turn their dream bathroom into a financial nightmare. They use the hammer to drive one big nail perfectly. It's also the right tool for consolidating a massive amount of high-interest debt. If you have tens of thousands of dollars in credit card debt at 25% interest, using a cash-out refi to pay it all off with a loan at 6% or 7% can be a life-altering financial move. You're taking chaotic, expensive debt and consolidating it into one structured, lower-interest payment. So the pros of the home loan are clear: stability, predictability, access to a very large sum of money at what is usually a relatively low interest rate compared to other types of debt. It's strong, it's reliable. It's a fortress against economic uncertainty. But what about the cons? Well, using a hammer isn't always elegant. The process is slow and expensive. You have to go through a full underwriting process just like when you first bought your house. That means appraisals, credit checks, income verification, and thousands of dollars in closing costs. It's a mountain of paperwork and a significant upfront expense. And remember, it's inflexible. Once you get that lump sum, that's it. You can't draw more money later. If Mark and Jessica's renovation suddenly costs $140,000 instead of $120,000, they're out of luck. They can't just go back to the well. They use their one shot. The home loan is a powerful but blunt instrument. It's for the big, definable moments in your financial life. But what if your needs aren't like that? What if you don't need a giant pile of cash all at once? What if you need something more fluid? What if you're facing a series of smaller, unpredictable expenses over several years like college tuition, or a rolling series of home repairs? Bringing a giant hammer to that job would be clumsy and inefficient. For that, you need a different tool entirely. You need something that acts less like a hammer and more like a financial Swiss Army knife, something you can pull out, use a little bit of, put away, and then pull out again whenever you need it. And that financial Swiss Army knife has a name: the Home Equity Line of Credit, or HELOC. Now, don't let the acronym scare you. The concept is actually something you're already familiar with. A HELOC is basically a credit card, but with two massive differences. First, the credit limit is huge, potentially tens or even hundreds of thousands of dollars. And second, instead of being backed by a pinky promise to the bank, it's secured by the equity in your home. This makes it a powerful and potentially dangerous tool. Unlike the cash-out refinance where you get a giant pile of cash all at once, a HELOC gives you access to a line of credit that you can draw from and pay back over and over again for a set period of time. Think of it like a checking account for your home's value. The bank says, okay, based on your equity, we'll give you access to $100,000. But that $100,000 doesn't just land in your bank account. It sits there waiting. You don't pay a dime of interest on it until you actually use it. This is where the flexibility becomes a game changer. Let's go back to our couple, Sarah and Tom. They want to renovate their home, but it's not one single project. First, it's the kitchen. Then, 6 months later, they want to tackle the master bathroom. And maybe next summer, they'll finally build that deck out back. They don't need $100,000 on day one. They need $30,000 for the kitchen now. Then maybe $20,000 for the bathroom later. And another $15,000 for the deck after that. If they took a cash-out refi, that full $100,000 would be sitting in their bank account from the start, and they'd be paying interest on every single penny of it, even the money that's just waiting to be spent a year from now. It's like paying for a 5-course meal when you only plan to eat the appetizer today. With a HELOC, they can pull out exactly what they need when they need it. They call the cabinet guy, he gives them a bill for $30,000. They write a check or use a special debit card linked to their HELOC, and boom, the contractor is paid. Now, and only now, do they start paying interest. And they're only paying interest on the $30,000 they've actually used, not the full $100,000 credit line. This initial period is called the draw period, and it typically lasts for 10 years. During these 10 years, it's an open line of credit. They can borrow money, pay it back down, and borrow it again just like a credit card. If they pay off $10,000 of the kitchen renovation, their available credit goes right back up. It's the ultimate financial accordion, expanding and contracting to meet their exact needs. And here's another feature that makes it so attractive during this draw period. The payments are often interest only. This means their monthly payment is incredibly low because they aren't required to pay back any of the principal amount they borrowed. They're just covering the interest charge for that month. So on that $30,000 kitchen renovation, instead of a hefty principal and interest payment, they might only be paying a few $100s a month. This keeps their cash flow incredibly flexible while they're in the middle of their projects. Feels easy, feels manageable, feels almost too good to be true. And that's where the other side of the blade on this Swiss Army knife starts to show. Because what happens when the draw period ends? After those 10 years are up, the accordion closes. The bank says, time's up. You can't borrow any more money, and your loan enters the repayment period. This is the part that trips up so many people. The loan is now converted into a standard amortizing loan, just like a car loan or a regular mortgage. Whatever balance you have outstanding at that moment, let's say Sarah and Tom used a total of $65,000 over the years, is now calculated into a fixed repayment schedule for the remaining term, which is often 20 years. And crucially, that interest-only payment disappears. Your new monthly payment is now calculated to pay off the entire $65,000 balance, plus future interest, over the next 20 years. This can cause a brutal financial whiplash known as payment shock. That comfortable low interest-only payment they'd gotten used to for a decade could easily double, or even triple overnight. Imagine your payment going from $300 a month to $900 a month, just because the calendar flipped from one month to the next. If you haven't planned for it, it can be devastating to your budget. But payment shock isn't even the biggest risk. The real danger, the sharpest edge on this tool, is the interest rate itself. The vast majority of HELOCs have a variable interest rate. This means your rate is not locked in. It's tied to a financial index, most commonly the US prime rate, which moves in lockstep with the Federal Reserve's policy decisions. When you hear on the news that the Fed raised interest rates, what that really means for someone with a HELOC is that their cost of borrowing just went up. Your monthly payment is not stable. Think about the last couple of years. We saw one of the most aggressive series of rate hikes in modern history. Someone who took out a HELOC when rates were at 3% suddenly found themselves paying 7, 8, or even 9% interest just a year and a half later. Their low interest-only payment wasn't so low anymore. Every time the Fed met and decided to raise rates, that person's monthly bill got a little bit bigger. It's a slow, creeping financial pressure that can become overwhelming. You're trying to pay down a debt whose interest cost is actively fighting against you, getting more expensive month after month. So, who is this tool actually for? The HELOC is perfect for the disciplined homeowner who has a clear understanding of their needs, but an uncertain timeline or cost. It's for the person who needs flexibility above all else. The person who wants a powerful emergency fund they can tap for a sudden medical bill or an urgent home repair, without having to refinance their entire mortgage. It's for the serial renovator like Sarah and Tom, who will be starting and stopping projects over several years. But it demands a plan. You must have a strategy for that payment shock when the repayment period begins. You must be comfortable with the risk that your interest rate could rise significantly, and you need to have the budget to absorb that increase. It's a tool that offers incredible freedom, but that freedom comes with the responsibility of managing its inherent volatility. So we have the brute force hammer of the traditional cash-out refi, a powerful but blunt instrument for getting a large, fixed sum of money. And now we have this incredibly flexible, but potentially dangerous Swiss Army knife of the HELOC. One gives you stability, the other gives you freedom. But what if you need something in between? What if you need a fixed amount of cash for a fixed purpose at a fixed rate without touching your primary mortgage at all? That's not a hammer, and it's not a Swiss Army knife. That's the financial equivalent of a scalpel, and understanding how to use it is the next piece of the puzzle. So what does this financial scalpel actually look like in the real world? Imagine this. You have a very specific, very expensive problem to solve. Not a series of small problems, not a maybe I'll need some cash later situation. I'm talking about a single massive financial mountain you need to conquer. Maybe it's consolidating a mountain of high-interest credit card debt into one single manageable payment. Or maybe it's that dream kitchen renovation you've been planning for 5 years, and you finally have the contractor's quote in your hand. It's a fixed number, $75,000. Not a penny more, not a penny less. This is the perfect scenario for a home equity loan. Unlike the HELOC we've hinted at, a home equity loan isn't a line of credit you can dip into as you please. It's a one-and-done transaction. You apply for a specific amount, say that $75,000 for the kitchen, and if you're approved, the bank cuts you a check or wires the full amount directly into your account. A lump sum, all at once. From that moment on, it operates just like your primary mortgage, which is why it's often called a second mortgage. You now have a loan for $75,000 with a fixed interest rate. Let's say it's 7%. You also have a fixed repayment term, let's say 15 years. For the next 180 months, you will have the exact same payment. Every single month. It will not change if the stock market crashes. It will not change if the Federal Reserve raises interest rates 10 times. It will not change, period. This is the superpower of the home equity loan. Absolute, ironclad predictability. It's the financial equivalent of a bomb shelter. You know exactly what you owe, exactly what your payment is, and exactly when it will be paid off. For people who live and die by their monthly budget, who find comfort and security in knowing there will be no surprises, this is an incredibly powerful feature. There's a profound psychological peace that comes with that kind of certainty. Let's go back to that kitchen renovation. You have the $75,000 sitting in a separate savings account. You pay the contractor his initial deposit. You buy the appliances. You pay for the cabinets. The project is completed, and you pay the final invoice. The money has served its single dedicated purpose. Now, you just make your predictable monthly payment for the next 15 years. It's clean. It's simple. It's a surgical strike. You identified the target, you deployed the funds, and now you're managing the aftermath on a schedule you can set your watch to. Another classic use case is debt consolidation. Let's say you've accumulated $50,000 in credit card debt across 4 different cards. The interest rates are brutal: 18, 22, even 25%. You're getting crushed by different payments, different due dates, and interest rates that feel like loan shark territory. You could take out a $50,000 home equity loan at, say, 8%. You receive the lump sum, and you immediately pay off every single one of those credit cards in full. The feeling of relief is immense. You've just cauterized a massive financial wound. Instead of 4 high-interest, unpredictable payments, you now have one single, fixed payment at a much lower interest rate. You've traded chaos for order. You've replaced a frantic juggling act with a simple, methodical repayment plan. That is the scalpel at its finest, making a clean, precise cut to remove a financial cancer. But a scalpel, for all its precision, has serious limitations. You wouldn't use a scalpel to build a birdhouse, and you wouldn't use it to fix a leaky faucet. It's a specialized tool, and if you use it in the wrong situation, you can do more harm than good. And this is where we have to talk about the dark side of the home equity loan. The first major drawback is its rigidity. Remember that lump sum? Once you get it, that's it. There's no going back for more. Let's revisit that kitchen renovation. The contractor starts tearing down walls and discovers a massive termite problem that wasn't in the original quote. It's going to cost an extra $10,000 to fix. Your $75,000 loan is already locked in. You can't just draw an extra $10,000. That money is gone. Your only options are to find that cash somewhere else or go through the entire application process again for a brand new, separate loan, which is a massive headache. The home equity loan has zero flexibility for unexpected costs or changing plans. It demands that you know the exact cost of your project down to the last dollar, and life rarely works that way. The second, and perhaps more subtle, drawback is how the interest is calculated. The second that $75,000 hits your bank account, you start paying interest on the entire amount. All of it. From day one. It doesn't matter if you only need $20,000 for the initial deposit and the other $55,000 is just going to sit there for 3 months until the project is finished. You are paying interest on money you are not using. Think about that. If your rate is 7% on $75,000, you're paying over $5,000 a year in interest. For 3 months, while $55,000 of that is just sitting idle, you've paid nearly $1,000 in interest for absolutely no reason. You're paying to borrow money that's just earning a fraction of a percent in a savings account. It's like paying for a full-course, 5-star meal but only eating the appetizer. You paid for the whole thing, but you're not getting the full benefit. This is a crucial and often overlooked cost of that lump sum convenience. And finally, there are the closing costs. Because a home equity loan is a formal second mortgage, it often comes with many of the same fees as your original home loan. You might have to pay an origination fee, an appraisal fee to confirm your home's value, title fees, and other administrative costs. These can easily add up to 2 to 5% of the loan amount. On our $75,000 loan, that could be anywhere from $1,500 to nearly $4,000 right off the top. So you're borrowing $75,000, but after fees, you might only walk away with $72,000 in usable cash. You have to factor that in. It's the price you pay for that stability and predictability. So who is this tool for? The home equity loan is for the planner, the budgeter, the person who has a large, specific, one-time expense and a very low tolerance for financial surprises. It's for the person who values the peace of mind of a fixed payment more than they value the flexibility of a line of credit. It's for someone who is confident in their numbers and wants to lock in a rate in a volatile market, shielding themselves from future interest rate hikes. It's for tackling a known dragon, not for exploring uncharted territory. The home equity loan is the master of the planned, predictable financial move. It's powerful, it's stable, and in the right hands, it's an incredibly effective tool. But what if life isn't predictable? What if your project has moving parts and unknown costs? What if you don't need a single lump sum, but rather access to cash over a period of years for multiple smaller needs? What if you need a financial tool that can adapt and change as your life does? For that, we need to put down the scalpel. We need to open up that financial Swiss Army knife and examine every single blade, every screwdriver, and every attachment inside. And that's where this choice gets really fascinating. So let's open it up. The first thing you notice about the HELOC, this financial Swiss Army knife, isn't one single blade. It's the mechanism itself. It's not a one-time transaction. It's an open door. A home equity line of credit doesn't give you a pile of cash. It gives you a special checking account, a financial reservoir tied directly to the value of your home. For a set period of time, usually 10 years, you are given a key to that reservoir. This is called the draw period. During these 10 years, you can turn the spigot on and off as you please. Need $20,000 for a kitchen remodel? You write a check from the HELOC account. 6 months later, you need $5,000 for a new furnace? You use the debit card that came with the account. A year after that, you decide to pay back $10,000 because you got a big bonus at work. You can do that too. And the moment you pay it back, that $10,000 is immediately available for you to borrow again. It's a revolving door of credit, using your home as the ultimate collateral. It's the closest thing most people will ever get to having a dedicated credit line from a bank, available on demand. And here's where the first major, and I mean major difference comes into play. During that 10-year draw period, most HELOCs give you an incredible and incredibly dangerous option to make interest-only payments. Think about that. If you borrow $50,000, you don't have to start paying back that $50,000. You only have to pay the interest that accrues on it each month. This creates an illusion of affordability. It dramatically lowers your monthly payment, freeing up immense cash flow. If you're a real estate investor flipping a house, or a small business owner managing payroll between big contracts, this flexibility isn't just a feature, it's a lifeline. You can use the capital, pay the bare minimum carrying cost, and then when your project pays off, you replenish the fund in one lump sum. It's a powerful strategic tool for short-term capital needs. But for the average homeowner, this interest-only feature is a siren song. Feels easy, feels manageable. You're using the money, but the monthly payment is so low it barely registers. But what you're not doing is reducing the debt. Not by one single penny. You are simply treading water, paying the bank for the privilege of using their money, while the principal balance, that $50,000 anchor, remains unchanged. You're kicking the can down the road. And with a HELOC, that road eventually ends at a cliff. This cliff is the end of the draw period. After those 10 years are up, the door to the reservoir slams shut. You can no longer borrow any more money, and your loan enters the repayment period. This is the moment of reckoning. The bank now takes whatever balance you owe. Let's say it's still that full $50,000, and they recalculate your payment. But now, you're not just paying interest. You have to pay back the entire principal plus the interest over the remaining term of the loan, which is typically 20 years. This is what bankers call payment shock, and it is a brutal awakening. Your monthly payment, which felt so light and easy for a decade, can suddenly double, triple, or even quadruple overnight. Imagine you've been paying just $250 a month in interest on your $50,000 balance. Suddenly, the repayment period hits. Now, you have to pay that $50,000 back over 20 years with interest. Your new payment could easily jump to over $500 or $600 a month or more. For 10 years, you had a small leak in your financial boat that you were easily bailing out with a small cup. Now the hull has a gaping hole and you need a fire hose just to keep from sinking. This shock has been the cause of countless financial disasters for families who were seduced by the low initial payments without truly understanding the math waiting for them at the end of year 10. But the uncertainty doesn't stop there. We need to talk about the most volatile, unpredictable tool in this Swiss Army knife, the variable interest rate. Unlike the fixed-rate mortgage, the scalpel that never changes, the HELOC's interest rate floats. It's tied to a benchmark financial index, almost always the prime rate. The prime rate is the baseline interest rate that banks charge their most creditworthy customers. And what influences the prime rate? The decisions made by the Federal Reserve. So when you hear on the news that the Fed is raising interest rates to fight inflation, it's not just an abstract economic headline. It is a direct memo to you that your HELOC payment is about to go up. Even if you haven't borrowed a single extra dollar, your interest rate can climb. And it can climb fast. A few years ago, the prime rate was hovering around 3.25%. As I'm writing this, it's closer to 8.5%. Let's go back to our $50,000 balance. At a 4% interest rate, your interest-only payment would be about $167 a month. Manageable. But if the prime rate skyrockets and your HELOC rate jumps to 9%, that same $50,000 balance now costs you $375 a month. Your payment has more than doubled, and you haven't done a single thing differently. You are a passenger on a financial ship, and the captain, the Federal Reserve, is steering you into stormy seas, and there's nothing you can do about it. The cost of your debt is completely out of your control. This is the fundamental trade-off of the HELOC. You are trading the certainty and stability of a fixed-rate loan for maximum flexibility. For some people, this trade is a brilliant move. Consider the parent who needs to pay for 4 years of college tuition. They don't need $80,000 on day one. They need $20,000 this fall, $20,000 next fall, and so on. A HELOC allows them to draw the exact amount they need, precisely when they need it, only paying interest on the money they've actually used. Taking a lump sum cash out refi would mean paying interest on the full 80 grand for 4 years, even while most of it was just sitting in a bank account. Or think of the homeowner who wants to do a series of renovations over 5 years. The kitchen this year. The bathrooms in 2 years. The backyard in 4. A HELOC is their standing fund for continuous improvement, without the cost and hassle of applying for a new loan for every single project. It's a tool perfectly matched to a long-term multi-stage plan. The flexibility is undeniable. The power is immense. But it demands a level of discipline and foresight that a simple, predictable home loan does not. The HELOC is not a piggy bank. It's not an emergency fund. It is a debt instrument secured by the most important asset you own, your home. Treating it like a casual line of credit for vacations or consumer goods is like using that Swiss Army knife to juggle. It's possible, but one wrong move has severe consequences. So we have these two profoundly different tools. One is a master of a single task, predictable, stable, and powerful. The other is a master of adaptation, flexible, accessible, but loaded with variables and potential shocks. They seem to exist in two different worlds. But the real question is, which world are you living in? And more importantly, how do the cold, hard numbers, the fees, the interest, the total cost over time stack up against each other? How do you move beyond the theory and calculate down to the dollar, which one will actually save you more money and put you in a better financial position? Let's pull back the curtain and get forensic. We're going to build a real-world scenario with real-world numbers and run them through both the cash-out refinance machine and the HELOC machine to see what comes out the other side. This is where the rubber meets the road. Meet Sarah. Sarah bought her home a few years ago and has a dream: a complete kitchen and master bathroom remodel. The contractors have quoted her $75,000. Her house is currently worth about $500,000, and she has $250,000 left on her original mortgage, which she was lucky enough to lock in at a beautiful 3% interest rate. Her credit is excellent. She needs to get her hands on that $75,000 locked away in her home's equity. Let's analyze her first option: the cash-out refinance. Remember how this works. Sarah isn't just taking out a new loan for 75 grand. She has to replace her entire existing mortgage. So she's applying for a brand new loan for $325,000. That's her old $250,000 balance plus the $75,000 in cash she needs. First, let's talk about the interest rate. That beautiful 3% she has? It's gone. Vanished. The market has changed. Today, even with her excellent credit, the best rate she can get on a new 30-year fixed mortgage is, let's say, 6.5%. And this is the critical, often misunderstood part. That new 6.5% rate doesn't just apply to the $75,000 she's borrowing. It applies to the entire $325,000 balance. She is refinancing money she already had at 3% into a new, much higher rate. Next up, the closing costs. Refinancing is not free. Lenders charge fees, origination fees, appraisal fees, title insurance, and a dozen other little line items that add up fast. A conservative estimate for closing costs is 2 to 5% of the new loan amount. Let's be generous and say it's 3% for Sarah. 3% of her new $325,000 loan is $9,750. That's nearly 10 grand she has to pay up front, or more likely roll into the loan, meaning she's paying interest on her own fees for the next 30 years. So what does this do to her monthly payment? Her old payment on $250,000 at 3% was about $1,054 a month. Her new payment on $325,000 at 6.5% for a new 30-year term will be approximately $2,054 a month. That is a $1,000 per month increase to her housing payment. It's a fixed, predictable payment, which is good, but it's $1,000 higher every single month for the foreseeable future. So to get her $75,000, Sarah has to pay nearly $10,000 in fees and increase her monthly payment by $1,000, largely because she's forced to give up her incredible 3% interest rate on her original mortgage balance. Now let's freeze that scenario and look at option 2, the home equity line of credit, or HELOC. With a HELOC, Sarah's amazing 3% mortgage stays exactly where it is. She doesn't touch it. It's sacred. The HELOC is a separate, second loan that sits behind her primary mortgage. It's a line of credit like a credit card for up to, say, $75,000. First, the interest rate. HELOC rates are almost always variable, meaning they can change. They're typically tied to a benchmark called the prime rate. Let's say today, the HELOC rate she's offered is 9%. Now your first reaction might be, whoa, 9%? That's way higher than the 6.5% from the refinance. And you're right, it is. But here is the multi-million-dollar difference. That 9% rate only applies to the money she actually uses. If her renovation costs come in at $60,000, she only pays interest on $60,000. With the refinance, she got the full $75,000 in a lump sum and started paying 6.5% interest on all of it from day one, whether she had spent it yet or not. Next, the closing costs. This is where the HELOC shines. Many lenders offer HELOCs with zero or very low closing costs. They might charge a small annual fee of $50 or $100, but it pales in comparison to the nearly $10,000 in fees for the cash-out refinance. For Sarah, this is an immediate, tangible savings of thousands of dollars. So what about her monthly payment? This is another huge difference. During the first phase of a HELOC, called the draw period, which is usually 10 years, lenders often only require you to pay the interest on the money you've borrowed. So if Sarah draws the full $75,000 for her project, her interest-only payment at 9% would be just $562 a month. Let's put that in perspective. With the cash-out refi, her total housing payment jumped to over $2,000. With the HELOC, she keeps her original mortgage payment of $1,054 and adds the HELOC payment of $562. Her new total housing payment is $1,616. That's over $400 less per month than the cash-out refinance option. But, and this is a massive but, the HELOC has a hidden dragon. The interest rate is variable. If the Federal Reserve raises interest rates, the prime rate goes up, and Sarah's HELOC payment will go up instantly. There's no protection. The second danger is what's called repayment shock. After the 10-year, interest-only draw period ends, she can't borrow any more money, and the loan converts to a repayment phase. She now has to pay back both principal and interest, usually over the next 15 or 20 years. Her payment, which was a manageable $562, could suddenly double or even triple overnight, depending on the interest rate at that time. It's a financial cliff you have to be prepared for. So let's put them side by side. The final showdown. Upfront cost. The refinance costs Sarah almost $10,000. The HELOC costs next to nothing. The winner is the HELOC by a landslide. Monthly payment. The refinance increases her payment by $1,000. The HELOC combination increases it by only about $560 initially. The winner, at least for the first 10 years, is the HELOC. Interest rate risk. The refinance gives Sarah a fixed 6.5% rate for 30 years. It's higher, but it's predictable and safe from market changes. The HELOC's rate is a moving target that could climb significantly. The winner here is the refinance. But let's talk about the single most important factor, the true total cost of borrowing that $75,000. With the cash-out refinance, the cost isn't just the 6.5% interest on the $75,000 she borrowed. The devastating hidden cost is the extra 3.5% in interest she is now paying on her original $250,000 mortgage balance. That 3.5% difference on $250,000 is an extra $8,750 in interest payments in the first year alone. Over the life of the loan, giving up that 3% rate will cost her tens, if not hundreds of thousands of dollars in additional interest. She is paying an astronomical price for that $75,000. With the HELOC, even at a higher 9% rate, the cost is simple and contained. She is only paying that rate on the money she actually borrows for the renovation. Her core mortgage, the biggest chunk of her debt, remains safe and secure at its super low 3% rate. When you look at it this way, for someone like Sarah in a rising interest rate environment who has a great existing mortgage rate, the math is overwhelmingly clear. The cash-out refinance, while it feels safer because of the fixed rate, is a financial trap. It's like burning down your house to roast a pig. The HELOC, despite its variable rate risk, surgically targets the new debt while preserving the massive financial advantage of her existing low-rate mortgage. So the numbers seem to point one way for Sarah's renovation. But what if your goal is different? What if you're not renovating a kitchen, but consolidating high-interest credit card debt? Or paying for a child's college education? Does the math change? And more importantly, are there psychological traps and hidden behavioral risks with each option that could derail your financial future, regardless of what the spreadsheet says? Let's dive right into that, because this is where most people get it wrong. They run the numbers, they build a spreadsheet, they calculate the interest savings down to the penny, and they feel like they've made a purely logical, rational decision. But they forget one crucial variable in the equation: themselves. Human beings. We are not robots. We are messy, emotional, and often irrational creatures, especially when it comes to money. And the financial industry knows this. The structure of these loan products is designed to interact with our psychology for better or for worse. So, let's ignore the spreadsheet for a moment and talk about the real world. Let's talk about temptation, discipline, and the hidden mental traps of a home equity line of credit versus a traditional cash-out refinance. First, the HELOC. The great appeal of a HELOC is its flexibility. It's not a lump sum of cash that lands in your bank account. It's a revolving line of credit you can draw from as needed. This makes it feel incredibly responsible. You're only borrowing what you need when you need it. It feels like you've just installed a financial safety valve on your house. But here's the psychological trap. Because it's so easy and flexible, it can start to feel less like debt and more like an extension of your checking account. It becomes the ultimate just-in-case fund. Think of it like this. A cash-out refinance is like going to the grocery store once a week with a strict list. You buy exactly what you need for the week, you come home, and that's the food you have. A HELOC is like living next door to the grocery store and having a store credit card with a $100,000 limit. Every time you think, I could go for some ice cream, or we're out of that expensive cheese, the store is right there and the credit is instantly available. Which scenario do you think leads to more unplanned, impulsive purchases? This is the danger of the HELOC. It's a tool of immense power, but it requires immense discipline. It turns your home equity, which is this abstract, illiquid concept, into a tangible, spendable resource available at the click of a button. And that can be disastrous if you haven't addressed the underlying behaviors that created the need for the loan in the first place. Let's make this real with our first scenario. Debt consolidation. Meet Sarah. Sarah has racked up $40,000 in high-interest credit card debt. The average interest rate is a painful 24%. She's paying a fortune in interest every month and getting nowhere. She's responsible, she has a good job, and she has a lot of equity in her home. She decides to take action. Path A is the HELOC. She gets approved for an $80,000 line of credit at a variable rate, currently at 8%. The math is a slam dunk. She immediately draws $40,000, pays off every single one of her credit cards, and breathes a massive sigh of relief. Her monthly interest payments plummet. She feels like a financial genius. She has slain the credit card dragon. But what she has really done is simply move the debt from one place to another. She hasn't changed the habits that led to the debt. And now she has a wallet full of credit cards with zero balances. That's a powerful psychological trigger. Few months go by. She needs new tires for her car. It's $800. In the past, she might have put it on a credit card and felt a pang of guilt. Now she thinks, I'll just put it on the credit card and pay it off at the end of the month. But she doesn't. Then a friend invites her on a last-minute weekend trip. It's only $1,200. The credit card makes it easy. Before she knows it, 6 months have passed. She's got $10,000 back on her high-interest credit cards, and she still owes the original $40,000 on her HELOC. She is now in a significantly worse position than when she started. She's paying high-interest debt again, and she's added a lien against her house. She used a HELOC to treat the symptom, the interest rate, without curing the disease, the spending habits. The easy access of the HELOC didn't provide a guardrail. It provided a shovel for her to dig the hole even deeper. Now let's rewind and have Sarah take path B. The cash-out refinance. She refinances her entire mortgage, pulling out a lump sum of $40,000. Her new mortgage has a fixed rate, and her monthly payment is higher, but it's predictable. That $40,000 cash hits her account. She systematically pays off every credit card just like before. But here's the crucial difference. The process is over. The bank account is empty. There is no open line of credit to tap. The cookie jar has been sealed shut and put on the highest shelf. If she wants to spend money she doesn't have, she has to use those credit cards again. And the pain of watching those balances creep up from zero is immediate and visceral. The structure of the loan itself imposes discipline. It's a hard reset, a one-time surgical procedure, not a revolving door of temptation. For someone who struggles with spending, the forced structure of the cash-out refinance can be the very thing that saves them from themselves. Now let's look at our second scenario. Paying for a child's college education. Meet Mark and Lisa. Their daughter just got into her dream school. The cost, after some small scholarships, will be $50,000 a year. They need to cover $200,000 over 4 years. The HELOC seems like the perfect tool for this. Why would they borrow all $200,000 on day one and pay interest on it for 4 years when they only need to pay the tuition bill every semester? Seems inefficient. So they open a large HELOC. They plan to draw $25,000 each semester as the bill arrives. This pay-as-you-go approach feels smart and savvy. They're minimizing interest costs. For the first year it works beautifully. But then in their daughter's sophomore year, two things happen. First, the Federal Reserve raises interest rates aggressively to combat inflation. Their HELOC's variable rate, which started at a comfortable 7.5%, has now jumped to 10.5%. The interest payments are suddenly much higher than they budgeted for. Second, the housing market in their area sees a slight downturn. It's not a crash, but values dip by about 10%. They get a certified letter in the mail from their bank. Due to the change in their home's loan-to-value ratio, the bank is exercising its right to freeze their line of credit. They can't draw any more money. They were counting on that HELOC for the last 2 years of tuition, and the tap has just been turned off. The flexibility they loved has become their single greatest point of failure. The risk they took on, the variable rate and the bank's control over the line, has come back to bite them, creating a crisis during one of the most stressful periods of their lives. Now let's consider the alternative, the cash-out refinance. In this scenario, Mark and Lisa refinance and pull out the full $200,000 up front. Yes, on paper this looks less optimal. They're going to be paying interest on money that's just sitting in a bank account for a while. But look at what they've bought. They've bought certainty. The rate is fixed for the life of the loan. It doesn't matter if interest rates go to the moon. Their rate is locked. The money is in their bank account. It is theirs. The bank can't freeze it. The housing market can do whatever it wants. They have secured their daughter's entire 4-year education. They can put the cash in a high-yield savings account or a series of CDs laddered to match the tuition due dates, offsetting a significant portion of the interest cost. What they did was make a trade. They traded a small amount of potential interest rate efficiency for absolute, ironclad, sleep-at-night peace of mind. For a critical, non-negotiable, multi-year goal like a child's education, eliminating risk is often the most valuable return on investment you can get. So when you're making this choice, you have to be brutally honest with yourself. Are you the kind of person who can have a cookie jar on the counter and only take one on special occasions? Or are you the person who will find themselves at midnight with an empty jar and a stomach ache? The HELOC is a high-trust instrument. Trusts you to be disciplined. The cash-out refinance is a high-structure instrument. Creates a system that protects you. Neither is inherently good or bad, but one is likely a much better fit for your personality and your specific goal. The question isn't just which is cheaper. The real question is, which structure will set me up for success and protect me from my own worst instincts? But beyond our own psychology, there are the hard realities of the loan agreements themselves. The fine print, the hidden fees, the prepayment penalties, the little-known clauses about balloon payments and demand features that can turn a great deal into a financial nightmare. What are the lenders not telling you in the big, colorful brochures? That's where the game is truly won or lost. Let's pull back the curtain on the fine print. The legalese that can cost you tens of thousands of dollars, or even your home. The first landmine is the prepayment penalty. It sounds counterintuitive, right? Why would you be punished for paying back money you owe? It's simple. The lender's entire business model is based on collecting interest from you over a long period. When you pay off the loan early, you're cutting off their profit stream. So they build in a breakup fee. It's their way of saying, if you leave us early, you're going to pay for the interest we expected to make. There are two main flavors of this penalty. The first is the soft penalty. This one only kicks in if you pay off your loan by refinancing with a different lender within a specific time frame, usually the first 2 to 5 years. They're okay with you paying it off if you sell the house or win the lottery, they just don't want you jumping ship to their competitor for a better rate. The second, more dangerous type is the hard penalty. This one stings no matter why you pay the loan off early. Selling your home? Penalty. Refinancing? Penalty. A surprise inheritance from a long-lost uncle? You guessed it, penalty. Let's put numbers to this. Imagine you have a $400,000 mortgage with the 2% prepayment penalty for the first 3 years. A year and a half in, you get a fantastic job offer in another state and need to sell your house. You're excited, you're moving up in the world. But when you go to close the sale, the lender hands you a bill for an extra $8,000. That's the penalty. $8,000 just for making a smart life decision. It's a gut punch. While federal regulations have made these less common on standard, qualified mortgages, they still exist in the world of non-traditional loans. And with HELOCs, you might not see a prepayment penalty, but you'll often find an early closure fee, or a requirement to reimburse the lender for the closing costs they covered if you close the line within the first few years. It's the same trap, just with a different name. Now let's talk about something even more terrifying, the balloon payment. This is a financial time bomb, silently ticking in the background of your loan documents. A balloon loan is structured to look incredibly attractive up front. Your monthly payments are artificially low, sometimes even interest-only, making you feel like you got an amazing deal. You're paying a fraction of what you would on a traditional mortgage. But here's the catch. Those low payments aren't actually paying down the principal in any meaningful way. It's all a setup for the grand finale. At the end of the loan term, say 5, 7, or 10 years, the entire remaining balance becomes due. All at once, in one massive house-sized payment. Imagine taking out a 7-year balloon loan on a $300,000 balance. For 83 months, you're cruising along with a comfortable payment. You're feeling great, maybe you even took on a little more debt because your monthly cash flow is so good. Then on month 84, the music stops. The bank sends you a letter that basically says, "Thank you for the interest payments. Now, please send us the remaining $280,000 by next Tuesday." What do? Most people assume they'll just refinance. But what if interest rates have doubled since you first took out the loan? What if your credit score has taken a hit? What if your income has dropped? Or the housing market has cooled and your home isn't worth as much? If you can't pay and you can't refinance, the lender doesn't negotiate. They foreclose. The balloon payment isn't a risk. It's a cliff. And the low monthly payments are just the deceptively easy path leading you right to the edge. But we can go one level deeper. We can talk about the clause that gives the bank the ultimate power, the one that should make the hair on your arm stand up. It's called a demand feature, or an acceleration clause. This little piece of text, buried deep in the contract, gives the lender the right to demand you pay back the entire loan balance, immediately, for reasons that can go far beyond just missing a payment. We all know if you stop paying, you lose the house. That's the basic agreement. But an acceleration clause is different. It means the bank can call your loan due even if you are a perfect borrower, making every single payment on time. What could possibly trigger this? Letting your homeowner's insurance lapse for even a day. Transferring the title of your home into a trust for estate planning without the bank's written permission. Sometimes, even taking out a second mortgage from another lender can trigger it. For HELOCs, it's even more insidious. Many HELOC agreements have clauses that allow the lender to freeze your line of credit, or even call the entire balance due if they believe the value of your home has declined significantly. Think back to 2008. Millions of homeowners were making their payments on time, doing everything right. But the market crashed, their home values plummeted, and the banks got scared. They started invoking these clauses, demanding full payment from people who had done nothing wrong, simply because the bank's investment, your home, was now riskier. It's the financial equivalent of a trapdoor. You're walking along, minding your own business, and suddenly the floor gives out from under you. All because the bank got nervous. It turns the traditional lending relationship on its head. You think you're in control as long as you pay on time. But this clause means the bank holds a hidden veto over your financial life. And specifically with HELOCs, the fine print is full of these little gotchas. The most common shock comes at the end of the draw period. For 10 years you've been enjoying the flexibility, maybe making small, interest-only payments on the balance you've used. Feels manageable. But the moment that draw period ends, the loan converts. It becomes a fully amortizing loan, and your payment skyrockets overnight. That $300 interest-only payment on a $75,000 balance can suddenly become a $900 principal and interest payment. That's a $600 a month shock to your budget. If you haven't planned for it, it can be just as devastating as a balloon payment. Then there are the fees. Oh, the fees. Lenders love to advertise no closing costs, but they make it back elsewhere. You'll find annual fees, a $100 a year charge just for the privilege of having the credit line open. There are inactivity fees, where the bank actually penalizes you for not borrowing their money. There are transaction fees every time you draw funds. They nickel and dime you, knowing that each individual fee seems small, but over the life of the loan, they add up to thousands. And we have to talk about the variable rate in the fine print. The big flashy sign says, rates as low as 4.99%. But the asterisk leads to tiny text that says the rate is the Wall Street Journal prime rate plus a margin of, say, 2%. That 4.99% is a temporary introductory teaser rate. The real rate is tied to the actions of the Federal Reserve. When the economy is uncertain and the Fed starts hiking rates to fight inflation, the prime rate goes up, and so does your HELOC payment. Instantly. There's often no cap on how high it can go. Your affordable line of credit can quickly become an anchor of high-interest debt. And it all started with an attractive teaser rate you saw on a banner ad. The bottom line is this. The interest rate is the headline, but the terms in the fine print tell the real story. The real cost of a loan isn't what they put in the big, bold numbers. It's hidden in the prepayment penalties, the balloon payments, the acceleration clauses, and the endless list of fees. Reading that loan agreement isn't just a formality. It is the single most important act of self-defense you can take to protect your family's biggest asset. So now that you know the minefield, how do you walk through it safely? How do you turn the tables on the lender and negotiate from a position of power? It's not about finding the best rate. It's about building the best deal. And that involves a strategic checklist most people have never even heard of. We'll cover the exact questions to ask your loan officer, the red flags to look for in the paperwork, and how to compare loan estimates like a pro, so you choose the loan that builds your wealth, not the bank's. Alright, let's pull back the curtain on the conversation that happens behind closed doors, the one that separates a good deal from a financial disaster. The most critical tool in your arsenal isn't a calculator. It's the right set of questions. When you sit down with a loan officer, you're not just a borrower, you're an interviewer. You are hiring them to provide you with hundreds of thousands of dollars. Act like it. First, let's move beyond the surface-level questions. Everyone asks, what's the interest rate? A pro asks, what is the APR? The annual percentage rate is the true cost of borrowing because it includes not just the interest, but also most of the fees, rolled into a single comparable number. A lender can dangle a seductively low interest rate in front of you, but then bury you in fees, making the APR much higher. Always compare APRs. Next, don't just ask, what are the closing costs? Ask, can I have a line item breakdown of every single fee on the loan estimate? And can you tell me which of these are lender fees versus third-party fees? And which, if any, are negotiable? This question does two things. It shows you've done your homework, and it forces them to justify every dollar they're charging you. You'll be shocked at how fees for processing, underwriting, or document preparation can suddenly become flexible when challenged. Then you ask about discount points. The question isn't, should I buy points? The question is, if I pay for these discount points to lower my rate, what is the exact break-even point in months? Your loan officer must be able to calculate this for you. If it takes you 7 years to break even on the cost of the points, but you only plan to be in the house for 5, you just lit that money on fire. For a HELOC, the questions get even more specific. Ask, what is the index your variable rate is tied to, and what is the margin? The index, like the prime rate, is the part that fluctuates with the market. The margin is the lender's fixed profit on top of that. A low introductory rate is meaningless if the margin is huge. Then ask, what are the caps on how high the rate can go, both annually and over the life of the loan? This tells you your absolute worst-case scenario. And finally, a crucial one for HELOCs. Does this loan have a conversion option to a fixed rate? And if so, what are the fees and terms for that conversion? This is your escape hatch if rates start to skyrocket. Now let's talk about the paperwork, because that's where the promises made in a conference room become legally binding. You need to become a red flag detective. The first and most important document you'll receive is the loan estimate. You should get this within 3 business days of applying. If a lender is hesitant to give you one, that is a gigantic red flag. Run, don't walk. Once you have the loan estimate, look for junk fees. These are charges with vague names that are often pure profit for the lender. Things like an application fee, a loan processing fee, or a courier fee in a digital age. Question every single one. The next red flag is a prepayment penalty. This is a clause that says if you pay off your loan too early, either by selling your house or refinancing, you owe the bank a penalty fee. It's designed to trap you. While they're less common in standard mortgages today, they can still appear, especially with certain types of lenders. Scan the loan estimate for the prepayment penalty line. If it says yes, you need to understand exactly what the terms are and seriously reconsider that loan offer. Another massive red flag is a balloon payment. This is a loan structure where your monthly payments are artificially low for a set period, say 5 or 7 years, but at the end of that period, the entire remaining balance is due in one giant, lump sum payment. It's a financial time bomb. If you can't pay it or refinance it, you lose the house. Unless you are a sophisticated real estate investor with a very specific strategy, you should avoid balloon payments like the plague. Now for the final, most empowering skill. Comparing multiple loan estimates like a seasoned pro. The law requires this form to be standardized for one reason, so you can put them side by side and compare them apples to apples. Don't just look at the monthly payment. Here's your 3-step process. Step 1. Compare page 1, the loan terms section. Look at the loan amount, interest rate, and monthly principal and interest. But here's the key. Look to see if one loan has points listed under origination charges, while the other doesn't. A lower rate that you had to pay thousands of dollars for might not be the better deal. Step 2. This is the most important step. Go directly to page 2 and look at section A, origination charges. This box contains the fees the lender is charging you directly. This is the single best place to compare the true cost of different lenders. Lender A might charge a 1% origination fee, while Lender B charges a flat $995 underwriting fee. Add up everything in section A. The lender with the lower total here is generally the more competitive lender. Sections B and C are third-party costs, which should be roughly the same between lenders, but section A is the lender's pure price tag. Step 3. Go to page 3 and look at the comparisons table. This is your cheat sheet. It shows you how much you will have paid in principal, interest, mortgage insurance, and loan costs after 5 years. This is a powerful comparison tool because it cuts through all the noise and gives you a hard number. Right below that, you'll see the APR again. As we said, this is the total cost interest rate. If lender A has a 6.5% interest rate and lender B has a 6.6% interest rate, you might automatically assume lender A is better. But if lender A's APR is 6.8% and lender B's APR is 6.7%, it means lender B, despite the slightly higher interest rate, is actually the cheaper loan overall once you factor in their lower fees. By asking these sharp questions, spotting the red flags, and using this 3-step comparison method, you shift the power dynamic. You are no longer just a hopeful applicant. You are a savvy consumer, meticulously analyzing the biggest financial decision of your life. You're forcing lenders to compete for your business on transparency and value, not on slick marketing and hidden fees. But even with the perfect loan on paper, there's one final piece of the puzzle, and it has nothing to do with interest rates or closing costs. It's about you. It's about aligning your loan choice with the life you actually plan to live. Because the math can be perfect, the rate can be the lowest on the market, but if the loan structure fights against your natural tendencies, your personality, and your life's trajectory, it will become a source of stress, not a source of strength. This isn't just a financial transaction. It's a tool you're choosing to build your future. And you have to choose the right tool for the job you're actually doing. So let's forget the spreadsheets for a moment and talk about people. Let's talk about you. Which of these sounds more like you? First, there's the strategist. The strategist has a plan. Not just a vague idea, but a multi-tab Google Sheet with color-coded cells and projected outcomes. They know exactly how much their dream kitchen renovation is going to cost down to the penny, because they've gotten 3 detailed quotes and have already picked out the specific model of refrigerator. For the strategist, uncertainty is the enemy. They want to know with absolute certainty what their payment will be every single month for the next 10, 15, or 20 years. The thought of a variable interest rate, an interest rate that could change based on the whims of the global economy, is enough to give them hives. They value predictability above all else. They want to set it, forget it, and know that the financial foundation of their home is as solid and unchanging as concrete. If you're nodding your head, if you're the strategist, the conversation almost ends right here. A traditional home equity loan or a cash-out refinance is likely your sanctuary. You get a lump sum of cash, the exact amount you calculated you'd need for your project. And from that moment on, you have a fixed interest rate and a fixed monthly payment. It's predictable. It's stable. It's a single clear number you can plug into your budget for the next decade and a half. There are no surprises. The HELOC, with its fluctuating payments and draw periods, is a wild card. And the strategist hates wild cards. For you, the peace of mind that comes from a fixed payment is worth far more than the potential flexibility a HELOC might offer. You're not paying for money, you're paying for certainty. But then there's another type of person, the opportunist. The opportunist thrives where the strategist trembles. They see the world not as a plan to be executed, but as a series of doors waiting to be opened. Maybe they're a small business owner who needs capital to buy inventory when a supplier offers a massive discount. Maybe they're a real estate investor who knows a distressed property could hit the market at any moment, and they need the ability to write a check within 48 hours to beat the competition. The opportunist doesn't know exactly how much money they'll need, or precisely when they'll need it. Taking out a huge lump sum loan for a maybe scenario is financial malpractice to them. Why pay interest on $100,000 sitting in a bank account, waiting for a deal that might not materialize for 6 months? If you're the opportunist, the home equity line of credit is your superpower. It's a financial multi-tool. It's a war chest you can keep at the ready, costing you nothing until the moment you deploy it. When that perfect, under-market property lists, you don't have to scramble to apply for a loan. You simply write a check against your HELOC. When your business needs a cash infusion to scale, the money is there, instantly. You only draw what you need when you need it, and you only pay interest on the amount you've drawn. The variable rate is a calculated risk you're willing to take, because the cost of a missed opportunity is infinitely higher than the risk of a modest rate increase. The HELOC's flexibility isn't a nice-to-have, it's the entire point. It's the fuel for your engine of opportunity. And finally, there's the juggler. This person is managing the beautiful, chaotic, and deeply unpredictable reality of family life. They aren't necessarily planning a single massive project. Instead, they're staring down a series of staggered, expensive, and often uncertain life events. They have one kid starting college in 2 years, and another one 4 years after that. The tuition costs are a moving target. The roof is 15 years old, and the contractor said it has another year or two maybe. The furnace makes a weird noise every winter, and they know a $5,000 replacement is on the horizon. They need a financial safety net, a shock absorber for life's inevitable and expensive curveballs. For the juggler, taking out a massive home equity loan to cover all these potential future costs would be insane. They'd be paying interest on money for a new roof that they might not need for 3 years. This is where the HELOC shines as a defensive tool, not an offensive one. It's the ultimate emergency fund for expenses that are too large for a credit card, but too uncertain for a specific loan. When the acceptance letter from the university arrives with the final tuition bill, they can draw the exact amount needed. When the furnace finally gives up the ghost in the middle of January, they can pay the HVAC company without draining their life savings. The juggler uses the HELOC as a private bank, a revolving line of credit that's there when they need it, and invisible when they don't. It allows them to navigate the financial minefield of modern life with confidence, knowing they have a powerful resource in their back pocket. So, which one are you? Are you the strategist building with precision, the opportunist poised to strike, or the juggler, managing the beautiful chaos? Be honest with yourself. This is the mirror test. It's about understanding your financial DNA. Do you lose sleep over market fluctuations? Or do you lose sleep over missed opportunities? Does a predictable payment schedule bring you comfort? Or does the idea of having your capital locked into a single-use loan feel restrictive? Your answer to that question is more important than any interest rate comparison chart. Because here's the secret. When you choose a loan that fits your personality, you're more likely to use it wisely. The strategist won't be tempted to overspend with a HELOC because they'd never choose one. The opportunist won't let a lump sum of cash burn a hole in their pocket because they'll opt for the line of credit they can control. And this brings us to the final crucial point. No matter which path you choose, you are taking on a significant responsibility. This isn't free money. It's a lien against your most valuable asset, It's a promise you're making to your future self. So, beyond choosing the right structure, you must have a plan. If you take the home equity loan for that kitchen, stick to the kitchen. Don't let the extra cash become a slush fund for vacations and lifestyle upgrades. That is the trap of the lump sum. If you open that HELOC, treat it with the respect of a loaded weapon. The temptation to use it for non-essential purchases, to cover for a lack of budgeting, is immense. The stories of people who maxed out their HELOC on discretionary spending and then got hit with rising rates and a job loss are heartbreaking, and they are real. Have a clear purpose for every single dollar you draw. A HELOC is a tool for building wealth or navigating emergencies, not for funding a lifestyle you can't afford. The journey to tapping your home's equity is filled with jargon, paperwork, and big numbers. But at its core, the decision is remarkably simple. It's a choice between a rock and a river. The home equity loan is the rock. Solid, stable, and unchanging. You know exactly what it is and what it will be tomorrow. The HELOC is the river. Flexible, powerful, and adaptable, but its path and its current can change with the seasons. Neither is inherently better. A rock can be a foundation or an obstacle. A river can be a source of life or a destructive flood. The only thing that matters is what you intend to build. So take this information, look in that mirror, and have an honest conversation. Understand your goals, acknowledge your temperament, and then, and only then, start looking at the rates. Because you are now equipped with the knowledge to not just get a loan, but to choose a financial partner that will help you build the life you envision, one smart decision at a time. You are in control. Now go build your future.